Welcome back to our channel, where we dive deep into the fascinating world of pharmaceutical giants. Today, we've got a blockbuster showdown featuring four industry titans: AstraZeneca, Johnson & Johnson, Merck Co, and Pfizer. We're breaking down their key financial metrics, explaining what each one means, and comparing them head-to-head to see who comes out on top. Buckle up, because this is going to be a roller coaster of insights and numbers. First up, let's talk about the price-to-earnings ratio. This metric tells us how much investors are willing to pay today for $1 of earnings from the past year. AstraZeneca leads the pack with a PE of 11.60, indicating a high premium, while Pfizer offers the highest at 19.75, suggesting it's seen as the most expensive relative to earnings. However, looking at the PE 5-year average, AstraZeneca's average is 20.02, showing consistent investor confidence. In contrast, Pfizer's PE has dropped to 10.96, reflecting a potential undervaluation. Looking ahead, AstraZeneca's forward PE rises to 16.49, making it more attractive for future gains. Pfizer remains the lowest at 10.23, hinting at potential value for savvy investors. Moving on to the price-to-earnings-to-growth ratio that considers the PE ratio relative to growth. AstraZeneca shines here with a PG of 0.85, suggesting it's undervalued considering its growth prospects. Johnson & Johnson, with a PG of 2.69, is on the pricier side, while Merck and Pfizer are reasonably valued after considering the growth prospects. Next, let's consider insider ownership, which shows the percentage of shares held by insiders. Johnson & Johnson tops the chart with 0.16%, indicating good confidence from within the company. In contrast, AstraZeneca has only 0.02%. But all four companies have very low insider ownership. Continuing with the profitability metrics, the return on equity showcases how effectively a company uses shareholders' equity to generate earnings. Johnson & Johnson leads with an impressive 23.91%, showcasing efficient use of equity, while Merck's 5.29% suggests room for improvement. In return on assets, Johnson & Johnson again comes out on top with 9.15%, proving its asset efficiency. AstraZeneca and Pfizer are close, at 6.36% and 9.44%, respectively, showing good asset management. Finally, in the return on invested capital, Merck impresses with 21.34%, indicating excellent management of invested capital despite more modest ROE and ROA. The evolution of shares outstanding tells us if a company is increasing or decreasing its share count. AstraZeneca is increasing shares at a compound annual growth rate of 2.4%, while Johnson & Johnson, Merck, and Pfizer are reducing shares by 1.4%, 1.53%, and 1.41% compound annual growth rate, respectively, potentially increasing existing shareholders' value. Now let's talk about earnings per share or EPS. Johnson & Johnson boasts a solid $10.46 EPS, leading the pack. AstraZeneca and Merck follow with $6.66 and $8.89, respectively. Pfizer trails with $1.42 but is expected to see a significant increase with a compound annual growth rate of 14.03% over the next 5 years, showing strong growth potential. In contrast, Johnson & Johnson is expected to grow EPS at a compound annual growth rate of 5.2%, showing a positive trend. Looking at the evolution of earnings per share during the last decade, we see Merck leading with a compound annual growth rate of 10.95% over the last decade, indicating robust growth. In contrast, Pfizer has struggled with a -5.03% compound annual growth rate, showing room for improvement. Continuing with the evolution of free cash flow per share, mirrors the EPS trends, with Merck again leading with a 9.26% compound annual growth rate over the last decade. Pfizer, however, has seen a decline with a -10.49% compound annual growth rate, highlighting cash flow challenges. And also a huge potential of company bankruptcy if the new investment in little companies does not meet the expectations of growth. For all you dividend lovers out there, Starting with dividend yield, Pfizer offers a generous yield of 5.99% with quarterly payments of 42 cents. Additionally, over the last decade its dividends have grown at a compound annual growth rate of 5.77%, but recently this growth has slowed significantly, and now has a free cash flow payout ratio over 100%. That means more debt issues and huge risk potential of dividend cut in the future. Secondly, Johnson & Johnson provides a solid 3.39%, with a compound annual growth rate of 6.02%. In contrast, Merck offers 2.44% dividend yield with 77 cents quarterly payments and 6.18% dividend growth over the last 10 years. Finally, AstraZeneca offers a dividend yield of 1.87% and 0.35% compound annual growth rate. So indicates less initial dividend yield and also less growth. However, its free cash flow payout ratio is lower at around 50%, indicating more dividend safety. When we analyze one company, it is essential to take a look at its margins. In this case, the operating margin is like the pulse of a business. Johnson & Johnson leads with 25.66%, indicating excellent operational efficiency, while Pfizer's 5.65% shows there's a lot of room for improvement. Another margin metric is profit margin, which follows a similar trend, with Johnson & Johnson at 19.51%, showcasing high profitability. Pfizer's 0.42% is respectable but not competitive in this group. It is to be considered that Pfizer skyrockets its margins in 2021 after the healthcare crisis and vaccines, but since then it has a lot of problems to keep its revenue and earnings. Over the last 8 years, AstraZeneca, Johnson & Johnson, and Merck have shown positive revenue and earnings evolution, reflected in their market performance. Pfizer's growth has been irregular, resulting in lower market returns compared to the S&P 500 ETF, VO, as we can see in the following graphic. Debt to EBITDA shows us how many years it would take for a company to pay off its debt using its earnings before interest, taxes, depreciation, and amortization. In simpler terms, it's like asking, how many years of my salary would it take to pay off my car loan? Pfizer is the most leveraged with a ratio of 9.54, indicating higher debt levels relative to EBITDA. This value is too high and any unexpected change can put the company in serious trouble. AstraZeneca has the lowest at 2.08, showing good financial health and management. Next, we have debt/free cash flow. This one tells us how many years it would take to pay off debt using the company's free cash flow, which is the cash left after all expenses, investments, and dividends. It's like asking, how many years of my leftover money after bills and fun would it take to pay off my loan? Pfizer also has a too high ratio, with a ratio of 13.87, needs to address its cash flow issues urgently. Fortunately, it is expected that during the next year it will skyrocket again. AstraZeneca and Merck are more balanced with ratios of 3.38 and 3.18, respectively, and Johnson & Johnson demonstrated that it is the most effective company in managing its leverage. But how well have these companies evolved their prices over the last 52 weeks? The average price return of the last 52 weeks shows AstraZeneca soaring with a 15.33% return, while Merck also had a good year with 11.21%. On the other hand, Johnson & Johnson and Pfizer dipped by -10.03% and -23.07%, respectively, and both companies are very close to 52-week low. All four companies have shown very strong market positions in the healthcare sector with market capitalization over $100 billions. Finally, analysts predict that in the next 12 months, AstraZeneca's price could hit $85.39, representing an upside of 10.41% from its current price of $77.34. But hold your horses. Personally, I believe the fair value is around $87.42 after adding a margin of safety of 15%, suggesting it might be undervalued at the moment. Also for Johnson & Johnson, analysts predict an upside of 17.23% from the current price of $146.48 to $171.72, but for me a reasonable price would be around $145.14 after adding a margin of safety of 15%, indicating a potential fair valuation and an excellent opportunity to add this company to our portfolios. For Merck Co., analysts predict an upside of 12.84% from the current price of $126.45 to $142.68, and for me a reasonable price would be around $124.18 after adding a margin of safety of 15%, which is very close to current price and suggests a potential fair valuation. Finally, for Pfizer, analysts predict that in the next 12 months, the price could hit $31.92, representing an upside of 13.8% from its current price of $28.18. But hold your horses. Personally, I believe the fair value is around $25.19 after adding a margin of safety of 15%, suggesting it might be overvalued at the moment. It is necessary to think that current debt levels of this company are too high, and without getting a consistent positive free cash flow, it would be impossible not to increase more. And there you have it, folks. An in-depth, head-to-head comparison of AstraZeneca, Johnson & Johnson, Merck, and Pfizer. Each company has its strengths and weaknesses, and now you're armed with the knowledge to make an informed decision. Which pharmaceutical giant caught your eye? Let us know in the comments below. If you found this video insightful, don't forget to like, subscribe, and hit that notification bell so you never miss an update. Until next time, keep investing wisely.